Lenders often refer to the 5 C's of credit whenever they're analyzing a loan. The 5 C's are capital, capacity, collateral, conditions, and character. Capital is an important factor in assessing a loan. An undercapitalized business increases its risk associated with the lending process. Working capital is something that we've talked about. It relates to the liquidity and the ability of the firm to meet its short-term financial obligations. And then we have equity capital, which is the amount that the owner has invested in the business. Equity capital is often a good measure of the risk-bearing capacity of that business, because as we potentially see losses, that's going to come out of equity capital. So lenders look at the capital using a current ratio, working capital calculations, and then of course looking at the equity capital and the relationship of equity capital to debt with the debt to equity ratio. Capacity relates to the repayment capacity or the ability of the business to meet their repayment requirements. We've looked at the term debt and capital lease coverage ratio and how it relates back to the ability of that business to meet their term debt requirements after they've paid off their operating loans. So repayment capacity is a very important aspect of lending. They want to know whether the business has the cash flow to meet their debt obligations in the short term, and as well as the profitability to meet the requirements in the long term. Collateral is a safety net. It is relied upon by the lender. If the loan fails to perform, if it goes into default, then the lender will look to collateral to try to offset the amount of that loan. It's very important that the lender identify the collateral, and as we'll talk here later about collateral, that collateral is very important, and there are different aspects of collateral that we need to take into account. The lender really doesn't want to rely upon collateral as a source of repayment. However, there are certain loans where collateral is the source of repayment. For instance, if you purchase feeder livestock to put into the feed yard, the feeder livestock would be the collateral that backs up the loan, and the feeder livestock would also be the source of repayment when they're sold. But whenever you're looking at equipment loan, the equipment that's being used as collateral for equipment loan is not going to be the source of repayment for that loan. And so we need to look at collateral in as terms of the type of loan that we have. Conditions refer to the economic conditions that exist for the business. What are the price prospects? What are the problems that industry may be facing? Whenever you're looking at a loan, particularly an agricultural loan, you might want to look at what are the conditions that that particular bar is facing with regard to the enterprises that they have. In other words, you've got to look at the industry and understand the industry whenever you're loaning money into that industry. Character is very important whenever you're assessing a loan. You want to make sure that the bar is honest. You want to make that judgment. What you're relying upon is that bar is going to make every effort to meet their financial obligations. In other words, to meet the repayment of that loan. So we assess character through the credit score, because we can see some things there that might indicate that someone is having some financial difficulties or they don't meet their obligations in a timely manner. We also assess character, particularly in relationship banking, just by knowing our customer and getting to know that customer and getting to know their business, and so we understand their character. So the 5 C's of credit are very important, and we'll be referring back to those in a number of cases whenever we're going through this section on credit analysis.